two targets. They're extremely simple. And let me jump back real quick. Anybody that I study charts up the wazoo, anybody that reads charts and they saw the charts, long-term charts of real estate and of the stock market, like say the S&P 500 NASDAQ, they would say, oh yeah, we're in a big fifth wave top and we're going to have a wave crash that's going to go back to the fourth wave low. The fourth wave low is March 2009 for stocks. You know how big a stock correction that is? 94% for the NASDAQ, 86% for the S&P 500. You know how much that is for the average house? 60 to 70%. This would make the 2008 downturn where housing went down 34% and stocks went down 57% look like nothing. That's what the charts say. And what it's basically showing you is how much longer and bigger this bubble was than the bubble that led to the tech crash in 2000, 2002, and then the generational bubble peak that led to the downturn 2008-9. I call that 2008 downturn 25 years before it happened, down to late 2007, because that's when the baby boomers would peak in their spending and shift the momentum down with Generation X. First thing, there's going to be winners and losers. Who are the winners? The young people coming along that have to buy a house and can't afford one, okay? Now that they've gone up, they're 4 times what they were just 20 years ago. And that's what you do. You have to look at your assets and say, look, where am I supposed to? A lot of people I know have a main house and have some sort of vacation house. Well, at least sell one of them. A lot of people in the main house are thinking of retiring in the vacation house anyway when their kids get totally out of the nest and they retire. And I would sell the one with the most equity and not the one with the most debt, because if you get a real debt crisis, banks are going to be forced to write down a lot of these loans that they made. They're the responsible party. They're the smart money here. You can't blame the average person for saying, well, everybody told me and the banker told me I could borrow this much. I didn't do anything wrong. The banks lent all this money to ever appreciate the same house that's now 4 times the price it was 20 years ago. It's the same house. It's not like a stock that's grown and has new markets and is moving into Asia. It's the same damn house. 4 times the price, and people lend and borrowing up to 90 to 100% again. So, same thing. Stocks are easy to sell. The good thing about stocks, if you say, well, I don't know if Harry's right or not, well, you can wait, but I'll tell you another fact I've researched throughout since the stock market was created. The first crash of a bubble, not a normal bull market, of a bubble, is 42% in 3 months. So that first crash, if you wait till then, you're going to get whacked really hard, and then you'll sell, but you'll already be down a lot. And then you'll sell, and then it'll bounce halfway back, and you'll think you missed that. And then it'll keep going down and you'll end up looking like a hero in the end. But you sell any real estate you can. That's the most important. And erase those debts for yourself and sell stocks. And if you're going to wait on something, you got to sell the real estate now, because real estate clams up quickly. If you say, okay, sell your real estate now, and then if it keeps looking like I'm right, then sell the stocks too. That'd be a stair-step way to do it. Well, all you have to do is look at 2008. And I've got a lot of people here in Puerto Rico, Peter Schiff, and a lot of people who have the same story I do: bubble, overspending, over debts, got to burst, financial bubble, and they say buy gold. Well, in 2008, gold did hold up at first, but it eventually went down with everything else and ended up being down about 40%. Well, that wasn't the worst place to be, but gold is not the safe haven. There is one safe haven, and all you got to look at is any deflationary downturn in history, like the 30s or what we've seen in 2008 and 9, Treasury bonds, the longest term. The best thing to appreciate and will be the safe haven, much more than gold, would be 10 and 30-year Treasury bonds, and the 30 years even better. There is an ETF called TLT, which is half 30-year, half 10-year Treasury bonds. That's the best ETF to buy. That went up 40% in 2008 when everything, including gold, finally went down. And this time I'm projecting TLT could double. Just that simple little ETF with 10 and 30-year, the highest quality, lowest risk bonds in the world, could double in value if we get as deep a recession as I see. In other words, and I tell people the way, how do I rate this downturn? They cut the 2008 downturn early, okay? It would have been deeper, longer. This downturn should be roughly stock declines, real estate declines, 1.5 times as bad as 2008. So if you thought 2008 was tough and you barely got through that, well, now you'll see why you really especially got to sell real estate, because you could be wrong about stocks. They could crash 40, 50%, but then take back half of that and you could still get out there and only be down 20, 30%, okay? It wouldn't kill you. But if you don't get out of expensive, especially high-end real estate, you'll never get it out at a good price and you'll lose a lot of money. Bitcoin is proposed as a safe haven. Not. I love Bitcoin, okay? It took me a while. I noticed that it was acting just like Amazon in the dot-com stocks in the 1994 to 2000 bubble, acting just like it. So I knew that this crypto was the next big thing. I didn't understand why at first. What did they do? What does Bitcoin do? Well, a guy was speaking at my conference years ago, and he said, it's the digitization of all financial assets and money. And I'm like, oh, now I get it. I'm the only guy in the world that right there could have told you $630 trillion in financial assets globally. The biggest financial number in the world, 5 times global GDP. So if crypto is about restructuring and making highly efficient, tradable, carvable, anything, manipulatable financial assets in a time where more and more people are becoming millionaires or near millionaires, that's going to be a big deal. So that's when I got, this is the next big thing. And so crypto's the big sector, and coming behind that close, something I always touted, I call it the automated professional and managerial jobs in my Roaring 2000 books way back, AI. So automating business and management. So that's NVIDIA and a bunch of stocks around that area. So the first things I want to sell, these are the most bubbly stocks, from Bitcoin to NVIDIA. Look at them. Both of them have bubbled more than anything. When things crash, those would be, if I had to buy 2 things coming out of this, it'd be Bitcoin and NVIDIA, because those are going to be leading the 2 supercharged sectors that are in their innovative stage about to move mainstream once we clear out this crash. And again, it's another reason. My thing is, get the damn crash over. If you carry all these debts and all these zombie companies on your back into the next boom, if we somehow wiggle through this without a deep recession, the boom's going to be compromised by carrying all that extra fat. And it's going to be fat. That's why the economy gets rid of them. That's why recessions are necessary. And again, we have had a substantial recession once a decade since World War II. There is a way, but first of all, if you're going to blow up financial assets to 5 to 6 times GDP, and that's what it is, okay, and they're going to come down at least in half, that's where money gets destroyed. It's not pulling out the money. This is in people's net worth and balance sheets, okay? That's going to get destroyed if this happens. The only thing you can do to mitigate this, and there's no way to turn it into no recession, you might be able to have a deep recession instead of depression, is if governments were to turn around to the banking system and help accelerate this. In other words, say, look, what we're going to do to cushion this, instead of just running deficits and stuff, every dollar you write off in bad debt, we're going to take 30% of it, some decent percent, to give the banks, and it's a limited time offer, banks. You got 2 years to do this. Any debts you write off, we're going to take 30% of it. We're going to take that on our debt, because we borrow cheaper than anybody, for the good of the system, and then help mitigate this so it becomes, but there's no way to have net worth of everybody drop this much and zombie companies go under, because there's a ton of them now, without at least a deep recession. But yes, it could be 10%, 12% unemployment. The Great Depression was 25. And that's one of the things I tell people. The difference between a recession, even a deep recession, and a depression is depressions follow bubble booms. When financial assets get way out of line with the economy, not just growth and plants, equipment and stuff, financial assets get overinflated, and that much money suddenly gets pulled out of the economy in the crash. 29 to 32. S&P 500, these are blue chip companies, went down 89% and did not get back to there for 25 years. That's why I tell people, this is not a rebalance your portfolio. You got to get out of the way of something this big, and it's once in a lifetime. This happens once every 90 years, this sort of level of a crash. We're in the maturing developed world. All developed countries are maturing. You know the one's going to last the longest? Australia, because they get massive immigration of educated Asians. They're not getting uneducated people coming across the border from Latin America. They're getting educated people from Asia. So Australia, if I pull up Australia's spending wave chart into the future, it looks like an emerging country, okay? But most developed countries are peaking and plateauing for a while and will eventually decline. We're the best house in that big neighborhood. Us in Northern Europe are going to hold up a lot longer. Southern Europe's already declining. Japan, South Korea, China, already declining in demographics, okay? And China's the first emerging country to peak and decline. But they're still going to be developed countries, and we're still going to be richer than most emerging countries for a long, long time. I'd say almost forever. So the U.S. is never going to grow like it did in the 50s and 60s or even 70s, 80s, and 90s, but we can still be a modest growth economy and still the wealthiest major country in the world if we clear out these debts and get and at least make the most of a slowing situation. So it's that simple. This shakeout will make everybody stronger except the weakest companies and weakest economies economies, and we're not the weakest economy in the developed world. We will come out stronger out of this relative to Europe than we are now, and much stronger. Japan is already dying. I was the first guy to say in the late 80s that Japan is the one that's going to burst. Everybody said the U.S. was going down. Said Japan's going down because Japan and South Korea are the fastest aging countries, and in the emerging world, China is the only, especially large, emerging country that's already in an aging pattern. They're going to lose 40% of their population in the next 50, 60 years. What does that do to you? That's not growth. That is shrinking.